everything from the start to the end, especially those who started reading this month. Maybe it could be helpful for you. We have question 1. And if you look into the previous question, there are things which are very common there, right? I think was it Campile? I hope I didn't mispronounce your name. You asked about audit planning, but we always have a question of planning and mainly risk assessment. Please quote me very well. The word mainly is very important. It's not all the time, mainly risk assessment. If you are revising for the rest of the days, you will notice that in the past papers, we have a question on risk assessment where they ask you for audit risks and audit responses. It's one section which is very common on this number. And most of the times, it's always going to be taking 10 marks and above. Then on the second year, we normally have audit procedures. In our course outline, it's topic C. Auditing procedures. Normally, this goes hand in hand with audit evidence. And then on this same number, so this is planning. If I want to put this as a section in the audit cycle, this is audit execution. And then the last one is what is under reporting. And what they normally ask about reporting is really forming an opinion. Forming an opinion, they can ask it in different ways. Those of us who did the mock test, I think you saw, we had a question which was asking, this is mock test 1, which was asking the implication if management refuses to make an adjustment of a misstatement of 266 million, right? So what the examiner wants you to be able to tell them is which opinion do you issue in different circumstances. And normally the examiner is basically pointing you to this knowledge around is there a misstatement? Is it material? Is it pervasive? And then what do you do? We have a table somewhere in our reading material that we use depending on the circumstances at hand, which opinion you actually do what you actually issue. But that area is very important. In some of the past papers, you will see a question around emphasis of matter, other matter paragraph, right? When do we use what? Under what circumstances do we use any of those, emphasis of matter or other matter paragraph? I am thinking we are going to get a bit of time and talk about some of those sections because they're equally very, very important. Then, so that is it about reporting. Normally, that's what is asked about reporting. But if the examiner asks you, or if you have to go and read under reporting, please, you can choose to read about what opinion do you form under what circumstances. But bottom line, we know that if there are no material misstatements, we issue unmodified opinion, right? And we know that if there are misstatements, then you have to go an extra mile and determine, is this misstatement pervasive? If it is pervasive, you give an adverse opinion. If the misstatement is material but not pervasive, then you give a qualified opinion. Sometimes people like saying except for, but that qualified opinion. And then if you don't have evidence, but you think the possible misstatements are both material and pervasive, then you issue a disclaimer of opinion. It's very important to have that sort of table on your fingertips, because when the examiner asks you, like in this previous mock test question that we did, the implication on the audit report, that's all they want. This is a material misstatement. It is not pervasive, and therefore we are supposed to issue a qualified opinion. Those 3 lines, you get your 3 marks, right? Then, yes. Yeah, the right word is qualified opinion, but people normally like saying except for. Because when we are wording it, we say, in our opinion, except for the effects of the matters described in the basis for qualified opinion, paragraph below, the financial statements give a true and fair view. So people like, being too specific and calling it except for, but the 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 right term is qualified opinion. So that is under. So this is number 1. Number 1, normally we are going to have a question under planning, especially risk assessment. Audit risk assessment. We normally have a question on auditing procedures, and then we normally have a question on reporting. But having said that, the examiner is at liberty to bring anything on number 1. There's a question, I think, in 2024 when they were 2024, 2023, when they asked about ESG. I don't know if you guys know ESG, environmental, social, and governance. I know that thing is everywhere I don't know, like it's just everywhere. When I was doing my tax practice paper, I was also surprised there was ESG, right? But that's just to show you that the examiner can bring anything on number 1. Don't go and say they told us risk assessment, audit procedures, and forming an opinion. No, the examiner can bring anything on question 1. And when they bring something on question 1, it's really compulsory. But one other thing that I like mentioning is that this is one of the sections which is easy to predict with a bit of certainty. I mean, it's compulsory, you can't avoid it. But then also, because it's very comprehensive, it's one area where you can focus your efforts and be able to fetch marks. Because if the examiner goes to section B and he brings a number on the topic which you have not even thought about, you won't be able to do what? To write anything. And that can happen because we have so many topics. We have group audits, we have other assurance services, we have internal auditing, we have quality management, practice management. Like we have a lot of things. We have corporate governance, we have risk management, we have what? Like there's a number of topics that the examiner can pick from. So that is it on section A. But section A, it's a case study, and normally when it's a case study, the things are in the case study. We just have to get away of picking them from the case study in a very, very organized manner. Then, the question I want to talk about is section B. I want to talk about the question on practice management. Somebody had asked about ISQM. This is the same thing. It is practice management or international standard on quality management, right? Why do I like talking about it? I like talking about it because if I went and picked the last 10 papers, 9, if not 10, will have a question on this topic. And it's always going to be the last question. So it's one of the questions which I think that if you have to read only one topic and go for the audit paper, only one topic like this, then it should be a topic on practice management or international standard on quality management. It's one topic, it's brief. I don't like saying it's easy because what is easy is relative. Especially when I'm talking to students. Students like saying that, for it's because you are a tutor. No. No, it's not because I'm a tutor, but it is brief. It is relatively friendly. It's not complicated, right? And then 3, yes, it is, but most importantly, it has to appear. 99.999%. Let me speak like doctors. That question is going to be there. So For me, if it is a question which you're sure that it's going to be there, then why not read it, right? Even if we say it is hard, but it's not that it's hard that it cannot be read. It can be what? It can be read. But then also, so please, as you're preparing, just create time and read, practice management. If anything is not clear, if anything is a bit confusing you, feel free to reach out. And this topic has two parts. The first part is elements of quality control. These ones I'll talk about them now so that I try to demonstrate how easy it is. Right? Elements of quality control. When we talk of elements of quality control, sometimes the examiner is going to say, maybe Flash and Robert are planning to start up an audit firm. Then, advise the two partners on what they should put in place to ensure that their audit work is in line with the quality standards. They just want this. They just want elements of quality control. They basically want you to mention the things that you're going to put in place that are going to ensure that you do work which is complying with quality standards, right? And what do we have under this area, under the elements of quality control? We have, there are about 8, right? We have governance and leadership. When we talk of governance and leadership, we were just basically saying, and I hope the person who asked about this topic, you're paying attention, because this is like the heart of the rest of this topic. We are basically saying that if you are setting up an audit firm, have leadership incorporated within your structure, right? What we mean is that you need to have the people with the right level of experience, with the right level of knowledge, entrusted with leadership for quality, right? So if you come to an audit firm, maybe it's XYZ partners, and we have a partner in charge of risk and quality. That's what we mean by you incorporating quality control within your governance structures, right? Like if I want my finance department to run well, I am going to put it in place, right? I am going to hire a CFO who will have a whole team of accountants to ensure that my organization is running my finance operations correctly. If I don't hire a CFO or a head of finance, a finance manager, then I will have incomplete records, I will have all sorts of those bad things that we know that can happen in what? In accounting, financial management, no approvals, no controls, fraud can happen, everything. But it's the same thing. We're saying that you as a firm, for you to manage quality, you need to have people in charge of quality. You make sure that you incorporate quality within your leadership and governance systems. Now, does anybody need 10 minutes to read this particular element? You don't need time. You just need to understand it and know it, right? We have ethical requirements. The way we do it is that if you have any question, if anything is not clear, please feel free to, you don't even have to raise your hand because I will not hear you. Because normally when I'm concentrating, no, I mean, if I'm to see if you raise your hand, I need to be seeing on the screen, right? But notice that I'm writing, my screen is shared, so I won't be able to see anybody raising their hand. So if you have a question, just unmute and speak. I will pause and then listen to your question. That is how we do it.
Good morning.
Yes, we can hear you. You have a question?
Just ask, are we just starting? Because I've just joined, I was held up as well.
We are just starting.
Thank you.
Okay, good. Yeah, so when we talk of ethical requirements, it's very simple. We know the fundamental ethical principles. We know them from our financial reporting, from a financial accounting, from audit of level 2, now we are finding them here. Integrity, professional behavior, objectivity, confidentiality. What is the other one? What's that one? Yeah. So what do we mean when we say ethical requirements as an element of quality control? We are saying that you as a firm, you need to have policies and procedures in place that are going to enable you and your staff to comply with the relevant ethical requirements. Is that a very long explanation? No. Very, very short and precise and to the point, right? That is all we want. So we are saying that if you achieve quality as a firm, you need to ensure that you have policies and procedures that are going to help you that are going to help you to be able to comply with the relevant ethical requirements. For example, I need to get your name. Huh? Albino. Okay. And the other one? The other one is simpler. Okelo. Okay. I'll use that one. So what we are saying is that if Okelo is starting up his farm, right? And it's like my internet has gone up. If Okelo is starting up his farm and he wants his staff to be professionally competent, right? He's going to have a policy in place, maybe about training, right? That is when those people are going to be able to do a good job, right? One of the ethical requirements that we have is objectivity, right? If I want my staff to be objective, if I want my staff to be independent while they carry out these audits, I will have a policy on independence, right? If Flash is having shares in company X, then I cannot assign her on the job to audit it, right? That is what I will have in my policy, right? I will maybe have a process to ensure that people do annual independence confirmations. I will make sure that people are trained about these things, right? Things of objectivity that people should be knowing them, right? I will make sure that people are trained, people have gone to school, people have learned these things, right? All those are policies to ensure that you are complying with what? With ethical requirements. So the ethical requirements, we know them. So how we comply them is determined by the policies and procedures that we put in place as an organization. Then, so that is ethical requirements. And what is the other element that we have that is? We have acceptance and continuance of client relationship. Acceptance and continuance of client so how do you accept clients? Okay, basically, first of all, the short explanation is as an organization, you should have proper policies and procedures on how you accept and continue client relationship, right? You don't take on any client. How do I explain it? In ICT, we have this thing called garbage in, garbage out, right? If you take on bad clients, don't expect to produce good work, right? By bad clients, I mean, imagine you take on a client who doesn't have integrity, right? Maybe a client who is not going to give you all the information you need. Maybe a client who is involved in fraudulent activities, right? Don't expect to produce good work after taking on that kind of junk of a client, right? That is one. I'm trying to get like a better context on how to bring it. Let me give you an example. It's very common, by the way. I hope there are no tax people in this office, rather in this class. You take on this client, and it's the kind of client who is going to say, but you see, if you declare all this profit, the tax is going to be too much. It's very common, especially in informal business. If someone says, uh, you see the profit is going to be, first of all, they even have incomplete records. That's the first thing. Like their books are not proper. The only thing you can look at and rely on is basically maybe whatever sales they've made on IFRS, maybe payroll expenses because they are, they have a certain schedule which they use to pay employees. But then you find that all the other things people just pay from the pocket, and stuff is not really together. Then when you produce like a draft financial statements after a long hassle, someone is like, no, this profit is too much. We cannot pay this much tax. They're like, but this is your performance, right? Now, already this person, what they are doing from a reporting perspective, they're going to make your tax number wrong, right? Because tax IS-12, we have current tax and deferred tax. The IS-12 tells us that current tax is supposed to be computed in accordance with the tax laws. So if this person wants to compute it according to his feelings and mind, already you are doing something wrong, right? So already your quality is what? Is going down. So that is why some firms are you're going to approach them and they're like, oh, we want you to audit our financial statement. And they say, well, no, because maybe based on the assessment of your business, your operation, your levels of integrity, you don't fall within their risk containment policies, right? That is one. Then two, the other way I can explain this better is that I have personally worked with an audit firm for quite a long time, and working in the industry has made me realize that there are some firms that do not audit certain businesses. Including the firm I used to work with, they never used to audit, for example, anything to do with casinos, anything to do with gambling, sports betting businesses, right? Because who knows what happens there, right? Like it's really very complicated to deal with such an industry, and the reason why they are not why they've chosen not to do that, they feel maybe they cannot get to the bottom of the operations of a typical betting or casino operation, right? Even people who work there, I don't think they also understand those things. Probably not, right? Then there are many firms that, not that forex bureaus are bad businesses, like with all due respect, but there are firms that do not audit forex bureaus. Reason being, because of the complexity around that kind of operation. So we could have used like Stanbic Bank. Even, so I think any bank. At my place, I use Stanbic Bank for like currency trading. If I want to convert from dollars to UGX, stuff like that. But you're going to go on the platform and the exchange rate is maybe 3620. You're going to come after 30 minutes, it's 3640. Afternoon, it is like 3500, right? So there's a lot of fluctuation, right? And if it's not really using a proper system, it becomes. Is somebody asking a question? So if you're not using a proper system, it becomes hard to really be able to maintain. I don't want to say proper information, but to get to the details of how everything is. How would you, for example, audit completeness of such revenue? Because things are changing. Those of you who use forest school, especially here around Kampala Road, you're going to enter the shop when the rate is 3620. Before you know it, they're telling you it's 3610. And those guys have even people who are stationed on the Bupande to keep rubbing and putting the rate, keep rubbing and putting the rate, right? So such kind of an operation is complex for you to be able to manage. I have not seen with my eyes that one of the biggest fraud that happens, like in banking sector, it's in the currency trading, right? That's why most of the banks have tried as much as possible to standardize it, right? Like if you're using Stanbic Bank, I don't know if they can negotiate outside the system, but they try as much as possible to ensure that the rates are picked by people right from the platform. So there's no human interaction, which could affect the what? The process. Then, so even the central bank, when they are licensing, you'll find that not all banks actually do forex trading. A bank had been in operation for 1, 2, 3, 4, 5 years, or even 10 years, but they've never reached a level where the central bank is comfortable to allow them to do currency trading, because maybe they've not built like robust systems that can actually help them to do what? To manage that kind of operation. So for you, you cannot just jump on search and you're like, oh, me, I'm going to audit it. How are you going to verify the revenue completeness? Because some sort of complex operation. So that is why you have to choose how to accept clients, right? The other thing I like using is an example of like the people that work on clothes, the tailors, right? You show up today, it's a Friday, and you're like, I want this shoot tomorrow, Saturday, I have a function, right? If I am the tailor, I would be like, no, I cannot do it, right? I yeah, I'm risk averse, but I'm relating it to the point of acceptance and continuance of client relationship. Because if I tell you that I'm going to do it, I am literally saying that I'm going to spend the whole night working on your suit. I am going to be tired, fatigued. I will work on it. I'll forget the buttons. I will end up spoiling. And then when you come tomorrow, it is bad. Like it's really looking very bad. And why is it looking bad? Because I have not given it the time that it deserves, right? So it's the same thing when it comes to accepting clients. You need to make sure that you accept clients when you are convinced that you have the time, you have the resources, you have the knowledge, you have the experience that can actually work on this client, right? Otherwise, you are going to end up doing very poor quality work. So that is how the way you accept clients, the way you continue client relationship is going to affect your what? Your quality. So that's why we say that as a firm, for you to be able to achieve quality, or as an element of quality management, you need to ensure that you have the proper process in place and right procedures on how you accept and continue clients' relationship. Which other elements do we risk assessment? In case you have old notes, you might find when you don't have this particular point, because it was introduced, I think, in 2023, 2024, when they made an enhancement to ISQM. I think it was made on 22nd or 23rd of December, 2023. So when they made an improvement to this standard, that is when that particular point was introduced. But what is this about? The same way we do risk assessment in business, even in when you're running an audit firm, when you're running a practice, you should do a risk assessment, right? As a firm, you need to assess your quality risks and then ensure that you put in place safeguards that are going to help you in addressing these quality risks, right? As simple as that. So you don't just wake up and all of a sudden you're managing quality. What are the quality risks that you have, right? And then you ensure that you have proper processes in place to deal with that. We have, what do we have? Engagement performance? Engagement performance. Now, engagement performance, um, it looks at how your audits are planned, how your audits are executed, how your audits are supervised, how consultation happens, how your audits are reviewed. And we are saying that this is going to contribute to your quality management. So what does that mean? As a firm, you need to have proper policies and procedures that are going to ensure that all your audits are well planned, all your audits are well supervised, all your audits are well executed and documented, that not reviews, differences in opinions are resolved, and consultation happens during these engagements. Engagement performance actually has a number of, we call them sub sections, where we have engagement planning, we have engagement supervision, we have engagement documentation, then we have record differences in opinion. There's the other one which I'm forgetting. We have consultation, right? So it has those different sub sections. So to ensure that all those are in place, they're incorporated within your audit process. That's engagement performance. What else do we have? Resources. If you're using the old standard, and you need to make sure that you look out for this, you could find yourself having just human resources, but it's supposed to be resources, because resources is not only human, but then we also have other resources. But what is this all about? It's basically, as a firm, you need to ensure that you have resources which are going to enable you to be able to perform audits in line with the professional standards, right? Under there, I think under human resources, we have different things we talk about under human resources. Like recruitment, you have to make sure that you're recruiting correctly. If you recruit bad staff, you think they're going to do a good job. Imagine you're recruiting incompetent people. So what would you expect? Your audits are just going to be what? Bullshit, right? I like using an example of some of the audit firms. Those of you could have seen them recruit or like heard about their recruitment processes. It's very, very intense. By the time you get the job, you really think you deserve it, right? Because they take you through, and moreover, they're recruiting you as a fresh graduate, right? But they are going to take you through a series of interviews. But that's to make sure that they get the right part, the right people. Not recruiting based on, I know this one, please go and start working. Those things may not apply in some of the audit firms that really care about their what? Their quality. Performance management. Performance management, of course, it's very broad. Do you set objectives for your team, and do you review their performance from time to time? Again, still using an example of audit firms, you find that I ever worked in an environment whereby they do an appraisal on you on every audit you finish, right? Let's imagine if you're like a senior, by the time you start there and finish there, you've done like how many audits? More than 50 audits, right? So by the time the year ends, you have appraisals on 50 engagements, and they're just going to add them up to get an average, and that is going to be your performance appraisal results. Now, if you're a manager, you will have like 100 engagements, get that. So those are like 100 appraisals. That shows you how intense it is, but that's part of managing your human resources to ensure that people are doing work that is in line with professional standards, right? It has things like reward and compensation. You make sure that you're rewarding what? Good performance, right? If I am doing a good job and I know that is going to earn me a promotion, I will keep doing a good job. But if I'm doing a good job, but I know that the other one will get a promotion because he's related to the boss, then I will also start doing what I feel like doing, right? So even your reward and compensation structures need to be able to promote quality management. There's many other things under HR, like learning and development. One of the things that normally happen is that you're recruited in an audit firm, they're going to give you a target. You need to finish your professional course maybe within 3 years or 4 years, right? Maybe they are going to tell you that every Friday, we do trainings, right? In audit firm environments, sometimes You find you have like a whole month where you wake up and go to office and just do training, right? No work. Like you wake up, leave home, go to office, sit and do training. That is to ensure that you have people who are going to be able to deliver quality. There's many other things that we can talk about under human resources, but you can read a little bit in detail from your notes. Then, of course, we also have under resources, we have no, is it methodology of work? I see it infrastructure, right? That's a separate element, right? No, IC infrastructure is under resources, but then the other one is information and communication technology. So the ICT infrastructure we're looking at are the tools that you are using, right? Right now we have like this era of remote working, right? Someone is here in Uganda, but they're working on an audit in Kenya, right? Someone is in South Africa, but they're working on an audit in Canada. By the way, currently it's very common for some of those countries in North America and Europe to, should I say, hire? Yeah, to hire like resources from within Africa. And you will never even know. But you have like a whole team of people that is somewhere in African countries and they're working on audits in North America because it's cheaper. The other side, you could get maybe an audit senior at $8,000, but here in Africa, you can get them even at $2,000. if you go to South Africa, it could be like $4,000 or five. If you come to Uganda, it will be like even $1,000 you can get someone, right? But what the point I'm driving is the ICT infrastructure, right? A very good example is some of the audit processing tools that most firms are using. You find that you have an audit processing tool that you use for your documentation and everything. In that, if I am here in Kampala and my colleague is in Arua working on an audit, the moment they go online, I can even see that they're actually in the file working. Everything they document is going to automatically synchronize with my file. So if I am a manager and I'm sitting in the office, I can actually review my team's work in real time, right? Somebody finishes the section, I'm going to review it and give them feedback, right? In that, if there's anything they need to rectify, they can actually do it there and then. Now imagine if you're in an environment whereby you're using your manual file, you come, you go to Arua, you go to Arua on a bus, do your audit, carry your file and come to Kampala. Then you meet with your manager, he reviews and he's like, yeah, you did not. Can you go? Sometimes you're already struggling with the engagement economics and you're like, this one, let's not go back. Let's just close it till we close it, right? But what I'm trying to say is that if your manager is able to use the current technology to review the work in real time, give you comments in real time, then there it makes the work. You won't even do the wrong work. You will just get it right the first time. The quality is going to be on point, and you will not have all these issues. What else do you have under resources? There should be like another third thing under resources. But you can pick it out as you study. But basically, you are trying to ensure that you have the right resources that are going to enable you to do work which is in line with quality standard. That is the easy and simple explanation. What else do we have? Is that all? We have monitoring. Oh, yeah, that one we are forgetting. Monitoring, we're saying that you don't just wake up and set these things and go and keep quiet. You have to keep checking if actually they are working the way they are supposed to be working. So if you think of like internal audit, I think this is like the internal audit of quality management, right? Okello has his firm. He has put in place his HR department. He thinks they are recruiting properly. He's hired competent people. He's put his procedures in place. He's had this thing on his governance system, all these things. He's done his risk assessment on quality, all those things. But he has to keep an eye. He has to keep checking to see if all these elements of internal control, of quality control are operating the way they are supposed to be operating. Then the one we are forgetting, information and communication technology. So basically this talks about firms having a proper process of how information is, one, received from clients, how information is processed, how information is stored, right? And how information is communicated. The way you store clients' information can affect your quality, right? The way you share clients' information can affect your quality, right? So you have to ensure that if you are running a practice, then you have a proper process, you have proper policies and procedures that are guiding how your information sharing is actually working within your what? Within your firm. Um, just 1 second. Yeah. So, because the way, like, in this current era, whereby as an auditor, you have access to a lot of information. So, if you don't have proper policies on how you share information, how you communicate, how you so we have a confidentiality requirement from an ethical point of view, but then also under that particular requirement, we have a bit of exceptions, right? On like how you can share information externally, right? Like what are some of the things you're going to consider before sharing this information externally? So what policies have you put in place? What have you clearly stipulated responsibilities for information sharing? If I get your information and maybe because I am part of the firm and tomorrow you find this information out there in the papers, it's going to ruin the reputation of the what? Of the farm. So you have to have proper controls, proper guidelines, proper procedures on how information is actually processed, on how information is communicated, both internally and externally, to ensure that it does not affect the what? Does not affect your relationship with your clients. I think currently with even the introduction of like the Personal Data Protection Office, there's like lots of guidelines about processing information and about sharing this kind of information. So those are the elements of quality control. So please take note. I like emphasizing this. If you see ISQM, this is what they are talking about. I ever got a student who came out of the paper and they said, there was a question on ISQM. I don't know what that is. I'm like, boss, we studied this. ISQM is International Standard on Quality Management. If you read papers before 2024, they will be having ISQC. It is the same. Before it was International Standard on Quality Control. Now it is International Standard on Quality Management. So ISQM, ISQC, it is really the same thing. Those are the elements. These things form like the bigger component of this topic. That is the first part. Then the second part of this topic, yes. No, it's okay. With what? Governance and leadership. Let me first try to put it in my layman's understanding, right? When we are talking of governance and leadership, we are talking of you incorporating quality within your structure, right? I like using the example of I am having a farm, right? Maybe we are 3 partners, right? Let's say I am in charge of maybe audit and assurance. Maybe Flash is in charge of tax, right? And Okello is in charge of maybe, let's say we've given him risk and quality, right? We can also have a farm where we have 3 partners and I'm in charge of audit. Flash is in charge of tax. Maybe Okello is in charge of consulting, right? The 2 farms are different. This one has somebody in charge of quality. The other one doesn't have anybody in charge of quality, right? The farm which has someone in charge of quality is very likely to exhibit high quality standards because they have got somebody specifically designated for quality, right? That is what it means to have quality incorporated within your leadership structure, within your firm's governance systems, to ensure that you establish an environment that is going to foster quality, right? I've worked with a regional firm that used to have a partner in charge of risk and quality, right? This is the person who's supposed to ensure that like quality reviews happen. Quality reviews is part of monitoring, right? This is the person in charge of ensuring that all engagements that need a quality control reviewer, it's the second part of this topic, they are actually assigned. So you find that when the financial year is beginning, like in January, or even by now, because now we're already planning for audits of next year, this is the person who's going to come and say, please, all the offices, you submit your audit engagements that need an EQCR, an engagement quality control reviewer, right? So that they get these people assigned so that in future, when these audits are happening in January, February, March, these quality reviews, these engagement quality control reviewers actually do the job. If you wake up and you're like, okay, my farm is running well, everybody knows quality, and yeah, we're doing it okay, chances are high that you're going to do what? To lose it, because after all, you don't even have a leader who is in charge of what? Of quality. Members, make sure that your microphones are on mute. Adinand, Deborah, make sure your microphones are mute. So that is governance and leadership. I don't know if that is clear for you. We're basically saying that as a firm, you need to ensure that you assign people within the firm's leadership structure with the right level of experience, with the right level of knowledge, with the right level of authority to spearhead quality within the what? Within the firm. So it strengthens, accountability. It strengthens our commitment to quality. It ensures that resources are provided to do what? To ensure that quality is taken as priority. Any questions on this one?
Mr. Victor, I'm inquiring if there is also ISQM2. Is there any difference between the one and?
Yeah, yes. Thank you very much. So that is the part we are going to. I said this part has mainly two. This topic has mainly 2 parts: ISQM1 and then ISQM2. ISQM2 is the engagement quality control review, right? Engagement quality control review is, as someone is asking, the difference between the two. This is more, how do I best describe it? When we talk of quality control, is at a farm level, right? Whatever we've been discussing, you can see that it's at farm level, like we are looking at the farm as a whole. But when we talk of engagement quality control, we are talking of a specific audit, right? If I use an example of engagements that always have quality control reviewers, they are either, let me just mention examples and you guys will see the categories where they fall. If you're like an audit firm, one of the jobs that is going to need engagement quality control reviewer is going to be a listed company. I don't think any firm can audit a listed company and they don't have an EQCR on the job. It is going to be having an EQCR. Then the other jobs that always have engagement quality control reviewers are banks. The other engagements that always have quality control reviewers are insurance companies. The other engagements are always going to be, has run out of my mind, manufacturing entities, right? The other engagements that normally have engagement quality control reviewers are like the retirement benefits schemes, especially the big ones like NSSF. Most of the times you're going to have an engagement quality control reviewer. When you look at those engagements, what comes into your mind? Probably the complex ones, the publicly accountable entities. Normally when an entity is a public, when I think according to the auditing standards, if an entity is publicly accountable, the risk is high, right? But automatically the risk is, it's considered a high risk engagement. People in insurance, banking, one, they are publicly accountable entities, but then they are also complex operations. Manufacturing is complex operation, right? So those are some of the jobs that always have engagement quality control reviewers. And the standards on quality management require that such jobs should have engagement quality control reviewers. Now, what happens is that when you set up an audit team and you say that we have a partner, we have manager, we have seniors, we have associates, right? Like the way we do it. I think you know this from level 2, where we talk about audit staffing. When you're setting up such a structure, on the side, you must have an engagement quality control reviewer. That is the guy who is supposed to do like a second review to confirm if he actually agrees with what the audit team has done, right? That is what ISQM is really all about. And we have procedures which are performed by the engagement quality control reviewer. There are things that he does on the what? On the audit file. For example, he also has to gain understanding. I think we had it in the test that we did, right? Did we have it in the test that we did? Yes, yes, yes. Roles and responsibilities of the engagement quality. It's one of the, I think it's one of the most common questions. Besides the elements, they normally ask the roles or responsibilities of the engagement quality control reviewer. But we know that, so when you're an EQCR, maybe let me first just explain like practically before we talk about these things that are written. If let me assume that this is the audit team, right? Okero, Flash, and what's your name? Chris. Rose. Okero, Flash, and Rose, they are an audit team, right? They've worked on this engagement, right? Okero is the partner, Flash is the manager, Rose is an associate or a senior, right? They've worked on this audit engagement. Now, if it's a kind of engagement that needs an engagement quality control reviewer, they could choose to assign Benson as a quality control reviewer. So for them, they are going to work on the audit and finish and the file is complete. Now we are going to give it to the engagement quality control reviewer. His job is to review it, and he confirms that the opinion we are about to issue is the right opinion, right? Should he have a disagreement with the audit team, because his review is supposed to be independent. If he has a disagreement with the audit team, then we have to do what? We have to make sure that that kind of disagreement is actually fixed. So what is this person going to do? This person we are calling the engagement quality reviewer. He's going to also obtain an understanding of the entity and its environment, right? How is he going to do it? He's going to review the information and have discussions with the engagement team. He's going to review whatever you have documented on the audit file. He's going to look at what you have, he can discuss with you. He's going to review what you have documented on the audit file, and he gains an understanding of the entity and the engagement, depending on the what? On the nature and the circumstances of this job, right? Now, just like we also do an understanding of the internet environment, it's also going to do that. It's going to do the same. Get to gain an understanding of this engagement and the circumstances around the engagement. Now, he's going to discuss with the audit team and the partner the significant matters and significant judgments that have been made in planning and performing this engagement. You know, like we also do that. When you're doing an audit, one of the things you're going to do, you assess the significant areas of the what? Of the audit. So he also has to. Now for him, the difference is that he will not going to go to the field to do that, but he's going to discuss with the engagement team, and he gets an understanding of the significant judgments that have been made and the significant areas that have been encountered while performing this engagement. So, after getting, of course, to understand the significant judgments, he's now going to review the audit documentation on the file, and he's going to evaluate. He's going to evaluate the basis for these significant judgments. He's going to evaluate the basis for these significant judgments. He's going to evaluate whether this documentation is appropriate, or whether there is sufficient documentation for the judgments that have been made. And then he's also going to evaluate if the conclusions reached are appropriate. So basically, after him understanding the significant judgments made, now he has to evaluate, based on the information that he has reviewed on the file, he's going to evaluate the basis for these significant judgments, right? Okay, people have made these judgments, right? But what is the basis of these judgments, right? And then, of course, is there documentation to support these judgments that we are making? And then, if the conclusions we are deriving from those judgments are actually appropriate. I am assuming that everybody has notes by this time, right? So, so anytime you can, this is just for explanation purposes, but you can go and, try to familiarize with the material that you have in your notes. So after looking at judgments that have been made, checking that the documentation is sufficient, checking that the conclusions are appropriate. Now he's going to review if the different ethical requirements have been complied with, if it is an audit of financial statement. I think by this time we know that ethical requirements are very important, especially when we are dealing with audit. So even the EQCL has to evaluate if the basis, sorry, if the ethical requirements have been met on this audit engagement. One of the things that I know when an engagement quality reviewer is looking at your audit file, you can fail to have all other things. But if you don't have an independence confirmation, simple as it might be, an independence confirmation, sometimes it's just one paragraph saying that, oh, we would like to confirm that the entire audit team is independent of this client, and it is my signature, Flash's signature, Okelo's signature, the people that worked on the job. If that one-page document is missing, you'd rather miss the entire audit section on revenue, but not miss that particular one, that particular simple page, because it's not explainable. Whereas you can explain that, oh, maybe based on our professional judgment, revenue was not material. You can give all sorts of, but you cannot explain how the team did not confirm independence. That is how strong and big these ethical requirement issues actually can turn out to be. Then, of course, it's also going to evaluate whether consultations have taken place, whether differences in opinion have been resolved, and yeah, whether the appropriate documentation is on the file.
ABC, please mute. We are getting feedback from your side.
Then he also evaluates if the partner's involvement on the audit was sufficient. So the EQCR, because he's reviewing the entire file, he also reviews if the partner actively participated in the audit. The partner is always the most experienced person on the job, right? So if his involvement is not good, then it speaks so much about the quality of the what? About the on how quality can actually be bad on this part, on this job. So he evaluates whether the audit partner was sufficiently involved in the course of the audit process. Then he also reviews the financial statements. He reviews the financial statements and the independent auditors report to confirm that they are complying with the standards. So this one thing you can notice is that he also participates in the audit like any other team member. So that's engagement quality control reviewer. Yeah, very commonly asked in some cases. So please take a look at it. So one other thing that I wanted to just add on is that this topic of engagement of practice management, sometimes it's combined with a question on risk assessment, on risk management. The topic, is it topic E or F in our course outline? But the topic about enterprise risk management, right? Normally they are combining this question with that, right? And then sometimes they put in other questions around professional ethics, like around how audit firms obtain business, the tendering, those tendering processes, or yeah, just normal ethical and ICPU related things. So as you're thinking about it, you can also extend your reading to those areas. So those are the two sections I want to talk about. The rest of the questions in section B, the other two questions, they are going to come from anywhere within the what? Within the course outline. And you know how many topics we have in the course outline. There are really many. So you can expect a question from any of the what? Any of the topics. I don't know if you have any question on practice management before we continue. So somebody is talking about audit rotation and file reviews, difference between 1 and 2. Okay, cool. So question 1, which is the case study, and we're going to do one case study together after our break. But what I wanted to emphasize is this. Sometimes they're going to do risks and responses, right? They might tell you or not tell you, but sometimes the easy way to do it is to use a table form. If that's audit risks and audit responses, you can use a table form. And this is your audit risks, and this is your audit responses, right? And then you do what? You do your, your writing like that, right? That is very okay if they ask you for both, right? Then in other cases, they are going to ask you just audit risks, right? Using the information available in the case study or whatever, identify the different audit risks that should be considered by the audit team in planning the audit of XYZ Limited, right? There you're not supposed to use the table. Just use paragraphs, right? And write your audit risks. But also, because they've not asked for audit responses, your answer is always going to be good and appealing to the examiner if you also mention the what? The audit response, right? I have seen it of late, it's very common. They just ask you for audit risks. Please go ahead and give the audit responses. The audit responses are not hard. They are the easiest thing, right? If it is an issue of maybe inventory valuation, it could just be something as simple as review the inventory valuation for compliance with IS2 requirements, right? If it is an issue of maybe, I don't know, reconciliation, it could be, obtain confirmations from customers or suppliers. If it's an issue of IS 37, maybe they've not provided for certain pending legal cases. It could just be as simple as the audit team will need to obtain legal confirmation from the company's legal advisor on the ongoing litigation, right? And you can, just build on that and have your audit responses. But it's always good, and your answer looks more complete once you add an audit response. I am hoping we can get a chance to do both numbers with asking both risks and responses, and when it's not, asking and then, but if time will allow us there, maybe we could do it. Then the other thing which I want to emphasize is that when you're writing your solutions for number one, do not copy and paste things from the case study. That is very common. I have a team that did the mock test. I know I've talked about this. I will still highlight it for the benefit of the rest of the members. Do not copy things from the case. Those things in the case study, everybody already knows them. So don't waste a lot of time copying them and putting them in your answer sheet, and you spend a lot of time on that, waste your paper, and then at the end of the day, you say, time was not enough, especially for number one. No, you most likely have wasted the what? The time. You need to conceptualize things from the what? From the case study. If I take an example of a very simple paragraph like this, let me see. Yeah, let me use this part. Let me use this simple paragraph. Prior to the global travel restrictions due to COVID-19, NAT Group had anticipated a very high demand for food and beverages based on the previous records for hotel bookings and reservations. The 5 hotels in the chain had ordered and received food supplies worth 922 million. Most of the foodstuffs and drinks had a short shelf life and therefore should have been consumed by the end of September 2020. It was discovered that stock of food and beverages worth 330 million expired, but management insisted on disclosing it as part of stock as at 31st October 2020. It was further discovered that additional stock of food and beverages worth 290 expired by 31st of October 2020 and was still included in the inventory in the draft financial statements. This paragraph is all about, we have stock which is expired in our closing stock, period. I don't want you to write any of these things in your solution. I just want you to come and give your pointers, inventory valuation. And what are we saying? There's a risk that inventory in the financial statements is overstated or misstated by including expired stock as of 31st of October 2020. Was it 2020? Whatever, whichever year. That is all you can even say, including stock worth 620 million in closing stock as of 31st of October. 620 million expired stock as of 31st of October 2020, right? And you're done. That's your risk. Like, we know how the financials are misstated. Then the audit response, you can choose to say, review the inventory valuation for compliance with IS2, right? Or it could even be discussed with management and ensure that expired stock is adjusted for or written off in the financial statements. I don't want you to come and say, oh, because what, lockdown, 330 million was expired and management has insisted, and then you come and say, hence, there's a risk that inventory is misstated in the Your point is too far. By the time the examiner gets there, he's already tired, right? If you want to put those details, please put them after putting the what? The point straight. And the point when you're doing risk assessment is what demonstrates how the financial statements are misstated, right? That is the point. That is the that is what we call an audit risk. If you can show that the financials are misstated by this, then that is the audit risk. But if it doesn't speak to the financial statements, then it will not carry weight as an audit risk. In most of the case studies you will be reading or the questions you will be revising, you will meet something around liquidity, cash flow challenges. If you put liquidity challenges, that is not an audit risk. Liquidity, so what? We all know liquidity problems. That's a financial management issue, right? Yes, it's a business risk, it's a financial management issue. But the actual audit risk, if a company is experiencing cash flow challenges, is going concern, right? If this company produces financial statements on going concern basis, when it's having all those operational challenges and it is not able to remain in operation for a foreseeable future, then we have a problem, because going concern is a typical financial reporting issue under IS 1, which provides for two bases of preparing financial statements. The other risk where people normally start misfiring is anything to do with legal, right? They are going to tell you a paragraph that, oh, this was terminated, people are threatening to sue, and people are busy saying litigation risk. No. Litigation risk, then what happens? I want you to be able to say that because of the ongoing litigation, there is a risk that expenses in form of damages and claims are not provided for in the financial statements as required by IS 37. That is a misstatement, because I'm saying the expenses and provisions are misstated. You can clearly see that I am speaking to the financial statement, but that does not explain how the financial statements are misstated. And if you are an auditor, you're supposed to be speaking to how the financial statements are actually misstated, right? So we need to take note of that. What else do I want to mention here before we go for a break? Audit risks. There are those common risks which are always in most of the case studies. One is this one of anything legal. Every time you see something, oh, someone is suing, you was terminated unfairly, please think about IS 37. That is the risk we are speaking to. Anything to do with cash flow challenges, borrow a lot of loans, liquidity, poor financial ratios like current ratio, all those things, please think about going concern as a what? Don't even waste time thinking. The moment you see anything to do with cash flow challenges, just put your going concern risk. It's going to be correct. Then the other risk, which is common, is this, I don't know, should I say hard topics? I don't know. What is hard is relative, but this, like, let me use not common topics, right? Like revaluation of property, plant, and equipment, like IFRS 16 leases. IFRS 9 is no longer, but if you find it, you can also highlight it as a risk. Basically, these standards which are not user-friendly, which are not very common. Normally, there is also a what? And it's very simple to come and say, the accounting treatment for maybe revaluation may not be in line with the financial reporting requirements, since management may not have the competencies to treat this correctly. And like, that's very okay. It's common for those new, unusual, and common standards. So things like intangible assets. When it comes to intangible assets, we even have additional things. Normally, they have indefinite useful life. Assessing impairment is very subjective. So that makes it what? That makes it complex, and they are prone to misstatement because of the subjectivity around some of those topics. So every time you see some of those things, think about just misstatement, because people may not have the required knowledge and experience on how to account for them in line with the accounting standards. Then the other common risk is, which one is the other common risk that we have?
Victor.
Yes.
Also, depreciation is the same issue. That is how it is being done. The accounting treatment, in
You're
case I
breaking. I can't
see
hear you.
it.
I can't hear you well.
Have you understood my question?
Try to speak again. I was struggling to get you, but now you seem to be a bit clear.
What I'm saying,
Yes, yes.
do we also consider depreciation in that manner?
No.
Do we also
Normally,
consider the depreciation in that manner
no, no, no,
of
no. Depreciation, no.
the accounting treatment for depreciation?
No. Normally, for anything to do with assets,
Sorry?
it's always a risk if it involves things like revaluation. But just normal depreciation, no. Yeah. Then the other thing that I want you
Okay.
to always look at is that when you're looking at these case studies, especially those that have financial information, always also look at the notes. The guy is going to give you his financial statement extracts. Please look at the notes. Normally, the notes have a lot of information. That's why they are going to come and say, maybe during the year, the company's building was destroyed by fire, right? What does that communicate? Maybe PPE is misstated, maybe it was destroyed and they haven't written off the what? The asset from the financial statements, right? That's why they are going to come and say, maybe the inventory count was not conducted, right? That should speak to that maybe the results we have in the financial statements are not accurate since we didn't do an inventory count. Some of those paragraphs could be there and you look at them as just basic additional information, but that's where all the risks are actually. Let's always look at them. Then in cases where they've given you financial information, normally when they give you financial information, the most likely question is going to be using analytical procedures, right? When they say use analytical procedures, sometimes they can tell you the ratios to use, sometimes they may not tell you the ratios to use. So you have to somehow be creative. But the ratios that we normally use are the usual ratios that we know from our financial management, our financial accounting. I think those ratios are like in every paper on CPA, including integration, right? So those ratios are really everywhere. But what I wanted to say is that once they ask you to use ratios, those ratios, all of them speak a particular risk. The first one is gross profit margin, right? Gross profit margin, we even have it under audit procedures. It speaks to revenue or cost of sales. If the gross profit margin is shifting from 20% to 30%, the risk is that either revenue or purchases are misstated in the financial statements, right? And what is the response? The audit team needs to review or check the revenue recognition or review the purchases to ensure that they are accurate, right? Are we together? So the gross profit margin, every time you think about it, every time you look at it, think about misstatement of revenue or cost of sales, right? That is one. Then the second one, the second ratio, normally for expenses, even when they start analytical procedures, don't really drill so much on expenses don't have a ratio, right? All you guys know about the ratio for expenses. As far as I know, there's no ratio for expenses. Always look at prior and current year. You look at the trend. How did the expenses behave? Did they increase? Did they reduce? And you look at that in line with revenue, because revenue is like top line. It should communicate what has happened in the rest of the what of the organization. I don't want to have revenue increasing by 30% and expenses are reducing by 20%. That automatically is an audit risk. And how are you going to highlight it? There's a decrease in revenue by 20%, despite the increase in revenue by 30, despite an increase in revenue by 30%. There's a risk that the expenses in the financial statements are not complete, period, right? And you're done with your audit risk. And then the other ratio we normally have on the P&L is the interest cover. What does interest cover tell us from our financial management?
PBIT over the interest expense.
Yeah, thank you very much. So our interest cover tells us by how much or how many times our profit can cover our financing cost, right? So if the interest cover is, if the ratio or the number of times is very low, then we are saying that the entity may not be able to fulfill its financing obligations, which normally feeds into the going concern risk. But also the other thing that I always want you to look out for is when you're looking at finance costs, even before you compute the ratio, always look at finance costs. You compare them against borrowing. But I think in one of the classes we were revising and we saw one area where the borrowings had increased and finance costs had remained the same. That's a risk. Remember when they say analytical procedures, I feel like analytical procedures is like one where they say use everything you can think of to come up with audit risks. Analytical procedures, you're allowed to do trend analysis. That's why like on expense, we are comparing current year and prior, and we are talking and we are commenting based on what is happening, right? But when we talk of still under analytical procedures, we can compare related information. Finance costs are supposed to be directly related to borrowings. In that if my borrowings are increasing, I expect my finance costs to also be increasing. If my borrowings are reducing, I expect my finance costs to be reducing, right? That's why when you're looking at finance costs in the P&L, also look at the borrowings. So that if you see finance costs behaving in a different direction compared to the borrowings, then that is an audit risk. If finance costs are remaining the same and borrowings are increasing or reducing, you're going to come and say, finance cost, that is your risk. And you're like, there's a risk that the finance costs in the financial statements are misstated since they are decreasing despite an increase in the borrowings balances in the statement of financial position. And what is the audit response? The audit team will need to review the borrowing agreements and the interest expense computations to verify that they are accurate, right? So you have to look at different relationships. And normally by that, oh no, there's also tax. If they want you to talk about tax, they're always going to give you the corporate tax rate in Uganda or whatever is maybe 30%, right? For you to comment about it, just go and look at the profit before tax and then multiply by 30%. I think one of the questions that we did very recently was a question whereby you have like profit before tax. Say this is 2025 and this is 2024. Say this is 90 billion and this is 60 billion. What is 30% of 60 billion? Quick math. 30% of, sorry, 18 million, 18 billion. The 90 billion times 30% is 27 billion. You know, you can find when this one is like 25 billion. Like all you needed to do was come and look at profit or loss before tax, multiply it by 30%. Sorry, they come and tell you this is the tax number. Then they tell you this is the net profit. And for you're doing your risk assessment, you need to come and see, okay, if I multiply 30% by 60 billion, this is, but when I do 30%, this is 7 billion, right? You come and say, you go talk of income tax, and you say, there's a risk that the tax amount in the financial statements is misstated, since the tax amount is not matching with the 30%, which is the effective corporate income tax rate, right? And the auditor's response is going to be, the audit team will need to review the current tax and deferred tax computation to ensure that they are accurate. This is an analytical procedure, by the way. You expect it to be 30%. That's why under analytical procedures, we have comparisons with anticipated results, comparisons with budgets, comparisons, the trend analysis, comparisons between related financial statements, line items. I hope we are together there. So that is on the P&L. P&L normally, in most cases, those are the things you're supposed to talk about. Look at gross profit margin, look at expenses, how are they behaving compared to revenue. Even cost of sales, you can compare them with budgets. I don't expect my revenue to grow and my cost of sales are reducing. What am I selling? Am I selling stolen things which I didn't pay costs for? No, right? So that is, then you talk about finance costs, look at them in line with balance sheet borrowings balances, and then tax, normally if you need what? The effective tax rate. And we are done with P&L. When we come to the balance sheet, this is where most of the ratios are. We have what does it tell us? Liquidity position, right? So when you're looking at current ratio, always think about going concern. That is the risk you should be having at the back of your mind. When you're looking at receivables days, current ratio and the other one is called what? Quick acid ratio. Or acid test ratio. Or quick ratio or acid test ratio, yes. Then receivables, turnover days. What does it tell us from financial management? How long it takes us to collect from our customers. Always look at it. If it is improving, we are okay. If it is declining, it means we are taking longer to collect from our customers. So normally, if the receivables days are declining, then it's an issue of receivables. If the days are increasing, it basically, you're going to come and say, there's a risk that the receivables value in the financial statement is misstated, since the company is taking longer to collect from its customers, and there's a risk that the provision for impairment is not accurately computed in the financial statements. So every time you look at receivables turnover days, think of receivables and impairment. Then inventory turnover days. Yes. So inventory turnover days tells us how long we take. Oh, someone has a question. It tells us how long we take to convert our stock into sales. Yes, Stella, you're correct. The decrease is okay. The problem is if, oh, okay. The problem here is that the decrease is the increasing. So when we are talking of receivables days, if they are going up, you are performing badly, right? So if the receivables days are increasing, then the risk is impairment. But if the receivables days are decreasing, then normally there is no risk. But there's also finding that they are decreasing, but it's really like a difference of 2 or 3 days and they are still high, right? You can still comment as such, right? You can still say, even though there's a decrease in the receivable days by 3 days, the receivable days are still high, and therefore there's a risk of impairment provision for bad debts is misstated in the financial statements. So inventory turnover days. Inventory turnover days speaks to how long you take to convert your stock into sales. If you are struggling to convert your stock into sales, the risk is that this stock could be slow moving, it gets expired like we have already seen in one of the previous paragraphs that we read, and also it could be that it could expire, it could be slow moving, it could become obsolete, right? And therefore, there's a risk that the inventory valuation is not accurate if any expired or obsolete stock is not appropriately written down in the financial statement. The moment you're taking longer, the risk is that you have this expired stock, you have this obsolete stock, or just this slow moving stock, which needs to be written down. Somebody has a very interesting submission here. Let me see what this is saying. I thought the tax rate difference could be as a result of either deferred tax movement. Hence, the effective tax rate can be different. The answer is no. If by the time you're mentioning this, it means that you have dealt a lot with financial statements. When you're computing deferred tax, you still use the effective tax rate applicable in the what? In the country, right? So when you're doing a tax computation in the financial statements, at the end of the day, you have to reconcile the tax position, right? At the end of the day, when you get your corporate tax and deferred tax, they should still be giving you 30% of the profit or loss before tax. Because everything that happens on the deferred tax account should come from your P&L. When you add back depreciation, you will bring wear and tear, right? When you bring provision for bad debts in the financial statements and you add them back in the tax computation, you're going to take it in the deferred tax computation as an asset. When you add back unrealized foreign exchange gains or losses or deduct them, you're still going to fit them into the deferred, even if it is revaluation, even if it is transfer of excess depreciation, all those things that you add back, depending on how you treat them differently in the tax computation, you're going to have to bring them back and reconcile them, all of them through what? Through deferred tax. At the end of the day, your tax number is supposed to be giving you exactly 30% of your profit or loss before tax. I know it's one of the things that most people always just mess up with in financial statements, but and that is why even IS 12, when you're doing the presentation, it's not compulsory, but you're supposed to put what we call proof of tax, right? It's a reconciliation of your deferred tax and current tax. And the moment it is not working, then it means that something has not been treated correctly, especially in the deferred tax computation. Based on my experience, I have made over 100 sets of financial statements with that kind of misstatement. But who cares? After all, nobody even understands it. So it's always like that. But the proof of tax is supposed to be there. So inventory turnover, always when you look at it, think about inventory impairment, right? So this is inventory. And now are you going to bring out your point? The company is taking longer to convert its stock into sales, and therefore there's a risk that the company has impaired stock, which may not be sufficiently written down in the financial statements, thereby misstating the value of the closing stock in the financial statements. What is the other one? Payables. Payables days, they show us how long the company takes to pay suppliers, right? So this is directly speaking to liquidity, which is the going concern. Risk. Any other? I know we have other ratios like debt to equity ratio, but No. We can spare those for our financial management classes. Is there any ratio that I've not? I feel like these are few. I don't know if there's one ratio I've not brought out. I think these are the ones. But the goal is to make sure that at least you know what each ratio is supposed to be telling you. Current ratio, think about liquidity. Inventory, receivables, payables. Oh yeah, the one for gross profit. It's somewhere. It is the P&L area. It's one we started with speaking about. Net profit margin. In some cases, yeah, but normally it's always addressed by that whole analytic we do on expenses. If you've gotten the analytic on expenses, normally you have already, because when you, from gross profit, we put expenses, right? So if there's any issue you have on the net profit margin, then you're still going to be speaking to expenses. Add it in case you want to compute it, or in case they ask you for it. It could be part of those they have mentioned. It could be speaking to operating expenses. OPEX. Interest cover, yeah. We talked about it, I just didn't write it. Yeah, I saw somebody texting. Do investors ratio also apply here? Oh, you talk about they're called investors ratio or investing ratio? Investing activities. Yeah, so those ones normally they do not really apply. But like the one for debt to equity, normally if it is to apply, then you find that it's already covered by the interest cover. If you have a lot of loans, interest is too much, normally it's going to come out in the interest cover ratio. But most of the times, I think based on my experience with the questions, I've not seen any question asking debt to equity ratio. But also if you look at it and you, again, this is risk assessment and planning involves a lot of judgment. If you think you can use the debt to equity ratio to explain how the company is having a lot of debt and that is going to get it into liquidity and cash flow challenges, please feel free to do that. So you can even mention it without actually doing any computation. And those are the things I wanted to say about this. The other thing question. Yes, Mandy.
I request you pardon me on that interest cover.
Interest cover. We said interest cover tells us by how many times our profit is able to cover our finance costs, right? So if you compute the interest cover and maybe you have profit of 100 billion, but you have interest cost of 25 billion, it means this is like 0.8. I don't know. Assuming this is the right number, then this is a problem. It means that your profits cannot cover your interest expenses. And what does that mean? That means that the company is going to meet its short-term obligations as and when they fall due, and that is a going concern risk.
Very much appreciated.
Kindly comment on any likely misstatements relating to deferred tax asset or liability. Oh, this is a hard question. I'm trying to see how it would come in. Deferred tax asset or liability. I don't know. Do you want to add like more context to your question? Are you saying they've brought this in the case study, or like where is it coming? How is it coming in? I'm not getting the question very well. On any likely misstatement relating to deferred tax asset or liability. August 2024. That was audit procedures for deferred tax, right? That's what was asked, right? Yes. But I'm wondering, like from a risk point of view, what are you trying? Make sure if you're speaking and you're not speaking to us, make sure your microphone is mute. But the person who texted in the chat, do you want to add context to your question? Maybe it can be helpful, but I don't think I really get it well. Because you're saying kindly comment on any likely misstatements relating to deferred tax asset or liability. I think how I would phrase it, depending on what they've told me, first of all, deferred tax, it's not very common. I have never seen a paper which has a risk on deferred tax. But depending on what the examiner says, one of the things I would use is deferred tax is complex, right? There's a risk that the deferred tax computation or the deferred tax liability is missing in the financial statement, since management may not have the competencies to compute it correctly. That is one. Compute it correctly or identify all the contributors to temporary differences that contribute to deferred tax. But I feel like I'm forcing that. Like I would need to have like proper context. But that's one thing. Like deferred tax is not something everybody knows or understands. So there's the aspect of people not having the experience and knowledge to be able to compute it correctly. That's the one I can really think of just off the top of my head. What else do I want to say?
Victor.
Yes.
I missed a point on expenses. There's something that you had said that if you're analyzing expenses, you compare
expenses. Expenses normally, when you're looking at them, look at them in line with what has happened to revenue, right? So look at prior and current year, right? If revenue has increased, I would expect expenses to also increase, right? So if revenue has increased and expenses are reducing, then that is a problem. If they are not moving in the same direction, or if revenue has dropped and expenses have increased, then we have a problem. So you're going to come and say, there's a risk that the expenses in the financial statements are misstated since there is an increase regardless of the decrease in the revenue performance. The audit team will need to review the entity's expenses and ensure that they are complete or correctly recorded in the financial statements. Normally they give us total. Oh, no, wait. Normally they're going to give us like admin, operating, finance. Normally that's the most common. I have not seen where they go in more details than that. So I would request you or like expect you to look at those as per the financial statements. Admin, operating, and maybe finance. Finance number is actually below. So the admin, operating, any other? Yeah. So look at the different categories. So even finance costs, we always look at them separately. Yeah. The rest of the things we are going to meet them in the question that we are going to do after the break. Sorry? Yes. Issuance of shares. So normally issuance of shares is not a common thing. It falls in the category of those not so common standards or scenarios people have to deal with. And the risk is always them not being accounted for appropriately in accordance with the standards. I think one of them that I have seen in one of the questions is issuing shares at a premium, right? And the risk is the accounting treatment of the shares may not be correct since the share premium and the share capital may not be properly allocated or separated. That's one. I have really not seen many cases involving issuance of shares, but I think anything to do with the issuance of shares, it's just the accounting treatment not be appropriate or consistent with the accounting standards. Yeah, the other reason why I think that account shares may not be can be just the risk can be just the basic risk of this is not a common topic. It's because people don't deal with really shares at all. Somebody joins an organization when the share capital is this much and they leave when it is that much, right? So it's not like something that people deal with like on a daily basis. And also the other thing which is common with shares is that information is not always available to all you see is that there's money on the bank. And they're like, oh, like the shareholders gave us money. And somebody just comes, debits the bank and credits what? Share capital, right? So that's where the risk normally is. The accounting treatment may not be correct as the proper allocation of share capital or share premium may not be in accordance with the standards. Then if they are shares being issued at fair value, no. If they're publicly traded shares, I think those ones we always have the information. It's publicly available. But if it is like any complex financial instrument, right, you can think about not having proper, like observable features against which you can validate the valuation of these instruments. But I don't know, I don't have like anything offhand that I can think of. But if it's really like a complex financial instrument, that's one of the things you can do you can look at. Not having observable indicators that can be used for valuation of those instruments. Someone is asking a question. Are substantive procedures the same as audit procedures? I don't know. What do you guys think? It's one of the categories. So my answer is always yes and no. My audit response can be a substantive procedure, right? But it's not that all my audit responses are going to be substantive procedures. Let me give you an example. If I have in the case study that, let me use the one that we just talked about. If I say, so review the accounting treatment for revaluation for compliance with IS 16. Is that a substantive procedure? It's something a bit generic. It is speaking to substantive procedures if you go granular, but it's something generic, right? But so that is where the no comes in. But if it is a case of receivables reconciliations have not been done in the last 2 years, and I say obtain external confirmations from customers directly of the balances outstanding, that is substantive procedure, right? So it is either or. In some cases, the audit responses could be the substantive procedures, and in other cases, substantive procedures. The audit procedures are not, the audit responses are not substantive procedures. I hope that answers your question, Khadija. So let's take a break, 10 minutes, and 10 or 15. 10 minutes. So 11:21, we should be back, and we continue.
Hello. Guys, I thought I coming back from the break.
Okay, let's move. So we're going to do question 1, March 2022. Question 1 of March 2022. I will first bring my screen that has the question and we go through it. So those who did test 2, yeah, that was your question. I like going to the, oh wait, did I unmute myself? Okay. I like going to the question
You
first
say
to see
no,
what the
December.
March 2022. I hope that's clear. I like looking at the question first, and this is what the examiner was asking. Part A, perform preliminary analytical review using the financial information, including the accompanying notes. Here they even specify provided by the finance director of LMN Pharmaceuticals Limited. Then Roman numeral, that was taking 10 marks. Roman numeral 2, using this information and the results from the analytical procedures, examine the audit risks to be considered in planning the audit. 20 marks. Then advise the audit team on what procedures to include in their working papers, obtain reasonable assurance on the following: whether controls on tangible non-current assets are in place. Then substantive test of details to verify tangible non-current assets. I think you can see we have a question on risk assessment and planning. Then we have audit procedures. Okay, that's enough for the case study. Case study, normally it's just part A that I'm interested in. So we go to our, they've given us the first paragraph is really Wolokoso, but they are telling us this is the statement of profit or loss as extracted from management accounts. We have 2020 and 2021, right? I think you can see revenue, cost of sales, gross profit, operating expenses, operating profit, finance costs, and profit before tax. Do you have profit after tax? No. Statement of financial position. Why do I feel like this now? Have we done this number? We haven't done this number before. Anyway, let's go through it because it has what we are looking for. Non-current assets, we have intangible assets, we have inventory, we have trade and other receivables, we have cash and cash equivalents, we have share capital, revaluation reserve, retained earnings, long-term borrowings, deferred tax liability, lease liabilities, bank overdraft, trade and other payables. Then we have total liabilities right there. So note, on the 1st of January 2021, LMN Pharmaceuticals entered into a contract which has been accounted for as a lease, with the right of use asset being capitalized at 13.5 billion. The leased property is used as the head office for LMN's new research and development center. The lease term is for 5 years. I think you can see. So here we expect to have a right of use asset in the financial statements. Are we together? And a lease liability. Do we have those in our financial statements? Yes. So already, we don't even need to think about that. Already we have a misstatement. If you have leased, IFRS 16 requires that a right of use asset and lease liability are included in the what? In the financial statements. Separately, the lease liabilities, I can see 13.5 billion, but the non-current assets, we are not seeing that. So that's already an issue. So on the 1st of January, the properties were revalued by an independent expert. When they revalue, we expect there to be revaluation surplus, right? Do we have it? Yes, we have 27 billion, but we shall still go ahead and highlight revaluation as a risk, since it's not common, complicated, it has a lot of things. you don't only stop on valuation surplus, you do transfer of excess depreciation, you do those deferred tax things on transfer of excess depreciation. We will highlight it as a what? As an audit risk. Then basically what I want you to see is like every time you read the note, think about the risk you can go to look out for when you're answering. The long-term borrowings are due to be repaid in 2 equal installments on the 28th of February 2023 and 2024. LMN is in the process of renegotiating the loan, extend the repayment dates, and increase the amount of the loan. So when you look at this, what do you think about? Cash flow challenges, and therefore that is going concern risk. The company has a court case with a competitor. What do we think about when we see that?
IS 36, 37.
We think
Risk.
IS 37. Thank you very much. So we're talking of those provisions, contingent liabilities, and contingent assets, right? The risk here is, okay, I haven't even finished reading it. Let me read it. The government has a court case with a competitor, Gato Limited, which alleges that the design used in Element Pharmaceutical Limited's medicinal tablets replicates the one of Gato Limited, which is protected under copyright. Evidence obtained was a verbal communication from the lawyers that claimed that a claim of 100 billion has been made against Element, which is likely to be paid. The moment they said likely to be paid, Finance Director has not made a provision arguing that it is immaterial. He declined our request to ask the lawyers to confirm their opinion on the matter in writing, saying it is not worth bothering the lawyers again on such a trivial. 100 billion is immaterial. When turnover is not even 100 billion. Anyway, but basically, the risk here is that the 100 billion expense has not been accounted for. And therefore, the expenses and the accrued liabilities have been understated in the financial statement. The overdraft agreed with Elements Bank is 4 billion. 4 billion. Man, how do you read this figure? 4 billion, 50 million. That one. The finance director is an unqualified accountant with no working experience. Does that bring any risk or there's no risk? There's a risk. If the finance director is unqualified, the risk of errors in the financial statements, since the finance director doesn't have the required knowledge and experience to prepare financial statements that are complying with the financial reporting standard. How do we respond to that risk? How do we respond to that risk? The risk. So you can set it as qualification of the finance director, right? And then you go ahead and say there's a risk of material misstatements arising from errors and misapplication of financial reporting standards due to the fact that the qualified accountant is not experienced, is not qualified, and he may not possess the right knowledge and experience to prepare financial statements that are complying with the financial reporting framework. Then how you respond to it? Somebody give me a response for this risk. This is the
Victor,
yes, yes.
can I respond by saying that then the audit team will have to review the HR policies on recruitment?
Will that remove the misstatements?
No, I was still saying
yes,
to ensure that the right people, because then also they need to have maybe an independent person to review these accounts.
Pastor Amanda, I'm not convinced. If I was the one giving the mark, I would struggle to give it to you. Yes.
Let me try.
Additional
Conduct
substantive procedures.
on the work performed by the finance director.
That's a good trial, but no. So this is a risk at financial statement level. Normally, these risks which are like affecting the entire financial statements, the best response is maintaining professional skepticism during the course of the audit. I know we've not talked about it so much, but I think in one of the, especially the first classes, I must have talked about it. So it's maintaining professional skepticism during the course of the audit. Okay, so let's get started. Perform preliminary analytical review using the financial information. So when they say something like this, they haven't really given us the ratios to compute. We can come up with our own ratios. So I will take away this and then bring my other screen. If you're speaking and not speaking to the class, make sure your microphone is on mute. So we are going to start with our analytical reviews. Okay, I think there's a lag between when I write and when it shows up here. I'll try to get some help from Alex, but we can continue. So analytical procedures, we start with, we compute the what? The ratios, right? In some cases, they're going to tell you, they could be separate parts, but in some cases, they could say using analytical procedures, identify the audit risks. In that case, you do a ratio and a risk, a ratio and a risk, a ratio and a risk. But if they ask separately, like here, where we have Roman numeral 1 and Roman numeral 2 is risks, then you first do the ratios and then you do the risks after what? After that. So we can start with what? With gross profit margin.
Victor,
Yes.
I was told that if they don't pose a question like compute the ratio and an analysis, they don't reward marks for the computation bit of it. Is it true?
Let me just mention this. I'll try to clarify it as much as I can. Okay. In this particular question, the question has part A, part 1, and part 2. Part 1 is saying, let me read it so that you don't say I'm getting it from my head. Perform preliminary analytical review using the financial information provided by the finance director of LMN Pharmaceuticals Limited. And it has 10 marks. Then part 2 is saying Using the information and the results from your analytical review, examine the audit risks to be considered in planning the audit. In this case, they are saying, do for us the ratios and then use the ratios to do the risk assessment. There, unless you want to leave part A not done, there you must do 2 parts, right? And all of them are going to get marks. But then there's when they are going to say, using analytical procedures, identify audit risks. And it's taking 12 marks or 17 marks, right? There, the chances are high that they are not providing marks for the computation, right? But you still are better off having the computation. Because there's no way you're going to come and say, yes, but in that case, the marks are only for the what? For the risk assessment. So I wouldn't want you to waste a lot of time, putting all these fancy formulas. By the way, I don't think those formulas add marks. Even when they ask for the ratios, I don't think those formulas take marks. You can put them, but that's not where you're supposed to spend a lot of your what? A lot of your time. Just go straight and do your what? Your computation. But if they are saying using analytical procedures, then there are no marks for the what? For the computation, right? But if they've specified that compute the ratios or you perform analytical procedures, then there you need to do the what? The ratios, and then the next part you do the risk assessment. So gross profit margin, what is the form of gross profit margin? It's gross profit over revenue. Yes. So for 2021 and for 2020, so what is our what is our turnover for 2020? Sorry, what's our gross profit for 2021? Out of then the other one is gross profit is what? 36 out of 79. What answers do we get here? You can even make it 42. That is our gross profit margin. We said gross profit margin speaks to revenue and expenses. Cost of sales. No, not expenses. Revenue and cost of sales. Normally, cost of sales, it's opening stock, add purchases, less closing stock. So we have to use that. Please post the question. One moment. So that is the gross profit margin. What other ratio can we do on a P&L?
Net profit margin.
We can do net profit margin and interest cover. This is net profit out of revenue, right? Which for 2021, it gives us our net profit was how much? Was it even a loss or it was a profit of how much? $12,366. I think this is operating profit.
Operating profit.
Yes. Then this is 15, 5, 6, 2, 15 to
What?
5 out of 7,910. This
Victor,
gives us
computing, is it operating profit margin or net profit margin?
let's compute one before tax, before interest and tax. The one which is based on it. $1,720. Okay. 19 point. So you can see that in 2020 and 2021, the net profit margin is declining. And normally when it's declining, we speak to the expenses because net profit is a resultant of what is happening in operating expenses. Then we can compute the cover.
What is the formula for the operating profit margin? Is it profit before tax?
It's profit before. It's profit before interest and tax. Why am I calling it? PBIT. Interest cover is equal to interest expense over. No.
It is
It's profit,
PBIT
profit before interest and tax over
interest.
Expense. In our case, this is 12,366 out of 40. Is that correct? Is that the right figure that we have? And then this is 15,255 out of 40. Very small change. I don't know if that flags any risk, but it's a very minimum change. Let's go to the balance sheet. In the balance sheet, we have receivables. Are you sure? Hold on a second. Sure. Sure. 5 is what? Wait. This is 2021, this is 2020. Yes. Yes. 2020. That should be okay, right? I think that should be okay. Yeah. So receivables, we know that this is trade receivables days. Trade receivables out of revenue times 365. So for our 2021, please, if you're not speaking to us, make sure you are on mute. Only unmute if you're speaking to the class. What is our receivables figure? $1350. 1330. Out of our revenue of 69,390. Then the other side we have 13,001 out of 79,110, giving us 70 days. So this shows you a deteriorating receivables performance. The risk is supposed to be impairment of trade and other receivables and valuation of inventory.
Victor, don't we use average receivables?
Average receivables. Do you even have average receivables in this question? Huh? Don't use average receivables. That's too much for audit. You can do those in financial management. For audit, we don't have to get into that level of detail. Okay. Inventory turnover. Inventory turnover days, it's closing stock. This one I know, I also know it has averages. Even this one has average stock. Yeah. So closing stock, so it's out of what? Cost sales, times 365. Our closing stock for 2021 is what? 4060 out of 40,284. And this is for 630 out of 42,930 times 365 times 365. What do we get here? Please, when you're writing the paper, don't write like that, the way I'm writing here. Eh? Make sure you write very neat work. No, this is not neat. So you need to write like you want marks. Me, I'm just writing. So this is 44 days. This is 39. It means that the company is taking longer to convert stock into sales. Hence, high risk of slow moving stock, which may be overvalued in the financial statements if slow moving stock is not written down. Payables days. This is what? Trade payables. Out of what? Cost of sales times 365. What is our payables balance in 2021? 50 out of 40284. And this is 42930. Okay. Times 365. 86 days. Company is taking much longer to pay their suppliers. Current ratio. Current ratio. Current assets over current liabilities. And our current assets figure.
Kindly scroll down a little
I
bit.
scrolled there.
Thank you.
Okay. So our current assets for 2021, 2020, our current assets is 18,436 out of, and this is 23,976 out of 9410. Right? So this gives us 2.5 to 1. This is a declining current ratio. We have stock, so we can do acid test. And this is current assets minus closing stock out of current liabilities. So it will be our current assets, which is, we can just subtract it from the calculator. So for 2021, it will be 13,576 out of 12,960. This will be 19,346. What do we get here? 2.1 to 1, and this is 1.02. This shows that this is now one. Imagine having a current rate of 1.0. Should any of the things fall off slightly, you're screwed up. Because for every one current asset, for every one current liability, you have only one to do what? Basically, you're running a budget, which is
Excuse me, Victor.
very tight. Yes, yes.
How come me I'm getting current assets minus inventory? Me I have for 2021, I have 5130.
Where have you gotten your current liabilities from? Sorry,
I'm only talking about the assets. I have 18436 minus 13306.
our current assets, it's let's do it together.
Okay.
It's 18,430, 435, 600 minus our current liabilities, which is minus closing stock, which is 4,860.
It's okay. I've seen my mistake. I was taking trade and other receivables.
Okay, cool. So I think that's all with the ratios, right? So now we go to part 2, which is risk assessment. Which risk do we start with? The one that was related to gross profit. So we are talking of revenue recognition. I think now I'm okay. Now one day. Revenue recognition. But let me combine it with cost of sales. It's advisable that when you're writing your points, please, you can state the point. Don't just start immediately and you're explaining. If you can state your point, that's much better. So revenue and cost of sales statement. And what are we saying? There is a risk that revenue, is it and or? And cost of sales are misstated in the financial statements as shown by the decrease in the gross profit margin above from what to what? 46 to 42. The question. While performing analytical procedures for this question, we compute and not write any notes about what we have computed. Yeah, don't write any notes on what we have computed. I've even never thought about it. Interesting. because like we do them for like a different reason. Like I honestly have never thought about writing, because the things you're going to be writing are not going to be audit things. So I don't know if it can add value, but no, I don't think we need to. And no, they don't need to. Don't you compute percentage change in this? No. Ah, that's what you mean. You guys are too specific. Come on. By the way, guys, this is not a financial management class. So you want to impress the examiner at the expense of your time. Like this is enough for audit. Like all the examiner wants to see is the fact that you know that if gross profit margin is moving, then there's a risk that revenue or expense or cost of sales are misstated. Whether the percentage is 10% or 30%, it's a nice to have, but it's not mandatory. Yeah. So what are we saying here? Yes. Yes. Yes.
Then is there anything we can speak on that part I about those additional notes?
So the question is there anything we can speak on the notes? No. Yeah. Yes. So normally the notes are supposed to help you with risk assessment to the bigger extent, right? Because now, like in this Roman numeral 1, I don't think we have anywhere where we can use this, where we can use these notes. Like if I look at them, if I look at the notes that we have, the right of use asset, no. Properties we have revalued, no. Long-term borrowings that be repaid in equal installments. This can complement, it will complement the point of our current ratio and cash flow challenges, right? Which is in the going concern risk explanation. I don't think we need to put it anywhere on the current ratio that we have just computed. Then the court case, that's in the risk assessment. That's it. Like most of the times the notes, if there's any place the notes are supposed to help you, it's when you are explaining or when you're analyzing your risk assessment. So what are we going to do? The audit will review the revenue recognition for compliance with according to combined revenue and cost of sales, IFRS 15. Yeah, then increase the extent and increase the extent of substantive procedures for cost of. Someone asked the question for the interest of time. Can they leave out the audit response since they haven't asked for it? No, don't leave it out. That's what I started with. Even if they've not asked for the audit response, it makes your answer complete. I would rather have it when it's not taking a mark rather than miss it. And I find that the examiner is actually giving it a what? It's actually giving it a mark. The reason why I am saying so is that I have most of the time seen when they produce we call it what? The answers, the solutions, the examiner actually does the same. So even though it doesn't specify that this was taking marks, but I think, those guys could be giving it what? Marks behind our backs. And most of it, not like this is taking 20 marks. Killian, why don't you want to put the audit response for 20 marks? Because there are too many. That was one risk. We already said we have a going concern risk. And what are we describing the going concern risk with? The company is experiencing liquidity challenges as shown by the deteriorating declining current ratio, acid test ratio, and no, current ratio, acid test ratio. What is the other one? Payables, days, and which data?
There is a
And
note which was talking about the liquidity of the company.
yes, the thingy, the borrowings which are approaching maturity. And
Exactly.
Also, Victor, if you look at even also the interest cover,
yeah.
it's also declining.
Yeah, which are approaching maturity without proper plan of settlement. So we're saying that the financial statements will be misstated if the financial statements, this is too much repetition. If presented on going concern basis and the entity is not able to remain in operation for a foreseeable future. The audit team will critically
assess the company's going concern as some assessment, the company's going concern status during
You can even say the audit team will carry out extended audit procedures around going concern. It's really the same thing. But all we're saying is the audit team should pay more attention to the going concern aspect during the audit. Yes. During the, this is wrong. Audit testing. Supposed to be audit testing. P&L, we've talked about gross profit. Did we talk about finance costs? I said we look at them with respect to the balance sheet which has the borrowing. So our finance costs are the same. I hope you noticed that in the question. It's 4 billion. It remained as 4 billion, 4,050,000 in both years. How did the borrowings behave? Our borrowing in 2020 was 67.5, 67.5. Down we have an overdraft of 3.5 billion. So our borrowings increased from 67.5 to 70.810, right? Yes. So we are saying that understated. We're saying that there is a risk that the finance costs are understated in the financial statement since they've remained constant compared to prior, despite the increase in the company's borrowings level. The audit team will review the interest cost computations against the borrowing agreements for accuracy and completeness. They might have forgotten the interest on the bank overdraft. Yes. Note 5 is the bank overdraft agreed with element is 4 billion. We are seeing 3.1, 3.510. I don't know. So this is the thing. Bank overdraft, you agree on a limit, but I could use something different. You could just say that you've given me an overdraft of 5 billion, but I have only overdrawn 2 billion. So my financials will have borrowings of 2 billion, but I will probably put the 5 billion in my disclosures. So in a full set of financial statements, I expect you to have a disclosure saying, oh, the overdraft facility is 4 billion, but the drawn amount as at the end of the year was 3.510. So I don't know if that's something we can drill on, but no, this is okay. So, what other risk did we have?
Victor,
Yes, yes.
I thought the finance costs, the only finance costs. Okay, I thought they are based on the long term, unless it has been like specified in the notes of
The
accounts.
finance costs are dependent, are only based on the long term.
That's what I thought.
No. Even bank overdraft, we pay interest on them. Even if you have a short-term loan of 1 month, you can still pay interest on it. So finance costs don't really have anything to say that this is long-term, this is short-term. It's applied on all borrowing.
Then I also wanted to ask, in case the procedure to be done is given maybe in part B, do you like first state the risk in case part A says you state the risk and then part B says procedure? Is it viable for me to like separate? For example, I write the risk, I answer that part 1 of the risk, then below I write the part B of the question. In
Your
case they are
question again?
okay, here the procedure that the auditor can do is given,
Yes.
but I'm asking for the case where you're given a question where part A, they're asking you for the audit risk, and for part B, they ask you for the procedure to be what? Procedure an auditor can undertake.
Audit responses.
Yeah, audit responses. Do I need to separate them, or I also answer them in this way? I first test the risk, then
If each question is separate, the best way to do is use a table. Your table should look like this. This is part A, audit risks. And then part B of the question, audit responses. The examiner will be able to see it. This is most how it's supposed to be. If they've asked you for audit risks and audit responses, and it's part A or part 1 and 2, then you do the table and label it like that. Okay. What you said, which risk are we putting next? Accounting treatment for the lease. for that. Okay. So what are we saying? We are saying that there is a risk that the unqualified accountant does not have the required knowledge and experience to treat the acquired list in line with IFRS 16. From the draft financial statement, the acquired lease, right of use asset. It's not disclosed by saying the audit team will review the lease accounting for compliance with the audit team will review the lease accounting or accounting treatment for compliance with IFRS 16. We have litigation, since we are on asset, accounting treatment for revaluation. So I think that the accounting for
Can you people mute?
Lucy Angolele.
Lucy, you're mute.
So you're saying that there's a risk that accounting for revaluation, which is material, is not in line with the requirements in IS 16, which requires revaluation of entire class, transfer of excess depreciation, and deferred tax on revaluation to all be taken care of in the financial statements. You can go ahead and say the accountant may not have competencies to do this. What are you
You
going
have
to say?
gone too fast. Yes, thank you.
So we're saying that if you've got competencies to do the auditing, will review. But it's 20 marks. But you see, the good thing is that everything is in the case. For compliance with IS 16. All the things are in the case study. That's why sometimes I think this is the number, which should be a bit easier to do what? To handle. All the things you are dealing with are in the what? In the case study. What else do we have in the balance sheet? Impairment of trade receivables. And we are saying there's a risk of the company's receivables are misstated, if sufficient provision for bad debts has not been included in the financial statements and the company is struggling. Is this the right spelling for struggling? Collect from its customers as shown by the high and declining. Huh. Can I say declining? It's high and going up. Yeah, you have to use your own English. By the high and I think it's declining. Let me just use high. By the high receivables days, 80 to 86. What are we going to say? What should be the audit team's response? The 60 and 70. 60 days. We review the provision for bad debts for and check that it's sufficient. Are we together? Any questions, team online? Anything you want clarification about? I hope as we are going through this, you're noting how you should be writing your answers. Don't start by copying for us things from the case study instead of giving us the audit risks, because that is going to just divert the examiner. And then try as much as possible to be precise, try as much as possible to be on point. Yeah, try as much as possible to be on track with everything. That's the reason why I'm writing. Otherwise, I would just be talking. But I write so that you can be able to see how your answers are supposed to look like in the what? In the exam. After this number, I won't be writing. You guys will just be giving the answers and we'll be brainstorming.
Me, Victor, can you kindly help me a bit up?
Victor, the notes.
Again, please. Okay, accounting for evaluation.
Excuse me, Victor.
Yes, please.
In the engagement webinar, they talked about materiality when answering these questions, but I've not seen you compute any as we are answering, so I don't know if it's not really relevant for this case. For example, now like here, this amount of the right of use of an asset.
Yes.
Since figure is given, won't it be like okay for us to compute materiality and then we include it? I don't know if the question is clear.
I get your question, but trying to see how. So the one thing that you care about is materiality when you're looking at this, right? I don't know maybe if that's the context with which the examiner talked about it, but you are concerned for balances which are material, right? Say, for example, if you look into our financial statements, the smallest amount that we have should be about, I think it's the finance costs, which is, finance cost is 1 billion, and maybe cash and cash equivalents, which is 270 million. I think that one is the smallest amount that we have, right? So if there was like an issue, let's assume like stock maybe was 200 million, right? I would want to say that it was not material, right? Because when you do, assuming we use our profit before tax as our benchmark for materiality, profit before tax, we normally use what percentage? 1 to 2%. Let's say 1%, if I take the lower end, times 46, what was our profit before tax? It's 8316. 8316 billion. Right? It would give me a 8316. Am I computing it correctly? 8316 times 1%. It gives me 83 million. Right? So this would mean that even when I had stock of 200 million, it would still be material. No, if what is the percentage that we use for profit before tax? It's revenue that has a lower percentage. So profit before tax should be 5 to 10%.
5 to 10%.
Yes, it's 5 to 10, not 1%. One is for revenue. So if I used 5, it would be 415 million, right? So that's where the aspect of materiality would come in. That if you have an issue, maybe you have like a misstatement or you have like something in the notes and it's like 200 million, then you would say that this is not material, right? But I don't see materiality being like something that really comes out in this particular question. Normally, when they want materiality to come in, they are probably going to tell you something. They are going to tell you, they're going to tell you something like, maybe the benchmark for materiality is this. Or somehow it's going to be mentioned. But if it is not mentioned in the question, I think we'll come to that later. If it's not mentioned in the question, then we shouldn't dwell so much on what? We shouldn't dwell so much on it. The other part where materiality is always important is always on the question on reporting. Like the question when they ask, the one where the part where we form an opinion on financial statements, that's where materiality becomes more and more important. But on the question of risk assessment, it's not really going to be the most popular thing. Even when you look at if you look at some of the most questions that we have in the previous papers, materiality is not going to be the most popular case that we consider in this. But if you have an issue and you feel the amount is very small, right? Then maybe that's when you can talk about it, or when you can, mention it somewhere in your responses. Okay, we'll talk about the benchmarks for materiality after this. Which other risk do we have? We have a risk on what? Inventory, yes, inventory valuation. And we are saying that the company's inventory turnover days are high and increasing from, is it the one that moved from 80 to 86? Well, I'm remembering my, moved from what to what? 39 to 44. As slow moving stock, which may start in overstatement of stock if the impairment is not properly assessed and stock written down. So what are we saying is the response? The audit team will review that what were they valuation, stock valuation, no valuation, movement, codes, and check that any slow moving stock, slow moving and impaired stock is written down. Which other risk do we have?
Victor, first scroll up. There.
So we are saying that we have this probable expense of 100 billion, which has not been accounted for in the financial statements. So I think expense of 100 billion which is included in the financial statement by the spending expression. This does not comply with the requirements in IS 37. I don't know if this line is coming at the right point, but understating the expenses and so what are we saying the audit response is? The audit team will obtain legal confirmation from the company's legal advisors and check uh, appropriately. Okay. Any other issue? When you look at the financial statements, our property, plant and equipment, we have intangible assets development. What was this development cost relating to? Did they even talk about it in the notes? No. I don't see anything like that. Wow. Or we could have development costs. That is IS what? IS 38. That would be development of what? Software. Oh yeah, yeah, there was something about medicine. Yeah, the leased property is used as the head office for Elements New Research and Development Center. Research and development. So the issue with those intangible assets, this is an intangible asset, right? With such intangible assets is that what do we capitalize? What don't we capitalize? IS 38. So it will with that treatment for intangible assets. And we are saying development. What now? This is complex to write. That the intangible asset is misstated due to difficulties in ascertaining which costs qualify to be capitalized, especially during research and I don't remember this standard very well. So the audit team will meet, will review the capitalized development costs for comply with the capitalization criteria in IS 38. This one, everyone can write the risk and the response. Qualification of the finance director. Qualification of the finance director. And we are saying that there's a risk that the financial statements are misstated due to errors and misapplication of standards. There's a risk that the financial statements are misstated due to errors and misapplication of standards. Since the finance director is not qualified and may not have the right knowledge and experience to prepare IFRS compliant financial statements.
Pardon, sir.
There's a risk that the financial statements are misstated due to errors and misapplication of standards due to, since the finance director is not qualified and may not have the right knowledge and experience to prepare IFRS compliant financial statements. The audit response, the audit team will need to maintain professional skepticism. The audit team will need to maintain professional skepticism. The others you can add on. But that's that's basically what it is. So after our break, after our lunch break, we shall look at auditing procedures and then materiality. I saw a lot of questions around it. And then we proceed to other sections. Do you have any questions before we go for lunch break? Or comments or additions?
Yes, an appreciation. Thank you.
Cool. Let's go for lunch, and it's going to be 1 hour. So 10 minutes past 2, we should all be back here.
Thank you.
Thank you.